So can you actually retire from just investing into the S&P 500 index? Well, in today's video, guys, we're going to be exploring this concept in a little bit more detail. I want to talk about how much money you actually need to invest and then how long it will take for you guys to actually go on to retire on that investment in which you've made. But before we get into that, guys, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a like on the video, guys. It really helps out the channel. With that being said, let's dive straight into it. So the average UK adult believes that they'll need £34,000 in annual income per year in retirement in order to achieve their goals. Now, with the general rule of thumb being that you need 25 times your annual desired income amount, either held in a pension pot, some kind of investment account, or even just liquid assets which you've accumulated over time, in order to sustain that level of living during retirement, you would need a pension pot or a total asset portfolio that equates to £850,000. But of course, that's only in today's money. When we actually account for inflation at 2.5% over the course of the next 30 years, instead of needing that £850,000 investment pot, you would actually need closer to £1,798,046, which would be the equivalent of an annual salary of £71,921 in the year 2052, which all of a sudden makes all of this feel a little bit more challenging. So I guess the question is, can just an investment into the S&P 500 get us to that desired portfolio amount of £1.8 million, which would get us into the ballpark figures of a luxury lifestyle in retirement based on the figures posted on pensionbee.com? Well, before we dive into that, let's firstly talk about exactly what the S&P 500 is for those of you guys who have never come across it before, and I'll also talk about why I personally invest into the S&P 500, along with how you can go on to invest into it too. But if you already are a complete expert on the S&P 500 and all things investing, then be sure to skip to the timestamp which I'm going to put on the screen here now. So what actually is the S&P 500? Well, simply put, it's the top 500 companies in the United States of America, which you can actually go on to invest into by investing into something called an exchange traded fund, which essentially just mirrors the index over on websites like Vanguard UK, as well as Trading 212. The ETF includes all of the big name companies which you've most likely heard of before, from big tech like Apple and Microsoft, right the way through to financial services like JP Morgan and Goldman Sachs, through to healthcare and pharmaceuticals like Johnson & Johnson, as well as many other stocks within the index too. In essence, you're gaining access to a ton of blue chip companies over in the United States of America, which has been one of the most prosperous economies over the course of the past couple of decades thanks to the technology boom. And as a result, as you'd probably expect, the S&P 500 index has performed fantastically well for investors, well, pretty much over the course of the past century, but more specifically over the course of the past 20 years, where returns have been very strong. In actual fact, since January 2002, 20 years ago, the S&P 500 has actually returned to investors 318.69%, which is a compounded annual growth rate of 7.42%. Now, of course, that doesn't mean that the S&P 500 will consistently go up in value 7.5% year in, year out, because sometimes the stock market goes up and on other years the stock market can go down. But as you can see from this data, over the course of the past 10 years, we've had 8 winning years and 2 losing years, with the best winning year seeing the stock market up 29.6%, with the worst losing year only being down 6.24%. So with many more winning years than losing years, and with far bigger gains than losses, that's why we've seen such great success in the S&P 500 for all of the investors that have invested into it. Now, that's pretty crazy to think about, because if we compare it to, let's say, another index like the FTSE 100 index, which is the top 100 companies in the UK, well, that's actually only been able to return 46.19% during the same period, which is only a compounded annual growth rate of 1.92%, which is actually not even able to keep up with the rates of inflation. So due to this, the S&P 500 is certainly my favored position when it comes to investing, in order to get a diverse collection of stocks all in a single fund. And another thing that I do really like about investing into the S&P 500 is the fact that it's reviewed on a quarterly basis, which means at any given point in time you have complete exposure to the top 500 companies over in the US. And that does mean that on a quarterly basis, kind of the best companies get added into the S&P 500, whilst the worst, perhaps less profitable, and the companies that aren't growing so much end up dropping out of the S&P 500. And we saw this most recently with the likes of Tesla back in late 2020, who did go on to get added into the S&P 500, and since then Tesla's stock has been on an absolute tear, returning just over 80% to investors, which isn't obviously just good for Tesla's stock, but it's also good to add more market value to the S&P 500 more broadly, which as of right now currently sits at a market value of over $40 trillion. So with such a huge amount of wealth being captured in the S&P 500, is investing into the index itself an opportunity for you to also generate, probably not 40 trillion quid's worth, but certainly a little bit of money in order to generate your own wealth and be able to retire early just from investing into the S&P 500? Well, as I'm a bit of a numbers guy, let's dive into the numbers. But before I do so, guys, I just want to say that obviously taking into consideration that not all of you are going to be in the exact same financial position now, nor indeed in the future. So because of that, what I'm going to do is kind of calculate a low, medium, and high future investment portfolio value based on a few of the different variables, which I'm going to tweak in just a moment's time. And remember, because we're calculating a total portfolio value after 30 years, as I said at the top of the video, guys, when we do the 25 times multiple of your income, we now need to do that in reverse. So we're going to divide the total portfolio value by 25 this time in order to kind of reverse engineer, if you like, in order to get an average annual income 30 years into the future. So first up, let's dive into the low end of the estimates. We're going to start off with an initial investment of just £250, and we're going to do that investment every single month for 30 years. Assuming that we're also increasing that amount by 2.5% per year based on inflation, achieving an annual rate of return of 7.5% over the course of that 30-year period, we will have accumulated an investment portfolio value of £434,485. And if we reverse engineer that number in order to turn it into an annual income amount during retirement by dividing it by 25, that would provide us with roughly about an annual income of £17,379 per year. Let's say at the median portfolio value level, you can afford to invest £750 per month this time, again increasing that amount every single year with inflation at 2.5%, assuming a rate of return of 7.5% over a 30-year period. Your investment portfolio value would be £1,303,401. The equivalent salary would be £43,446 per year, which seems pretty crazy to think about, but it actually wouldn't even get you into the luxury lifestyle category on the basis of 30 years worth of inflation eroding your wealth over time. But if you're able to increase your monthly contributions to £1,250 per month, which seems pretty steep for probably quite a lot of people out there, but if you were able to do that, again, assuming the 7.5% rate of return per year, again, increasing that amount with inflation at 2.5% over the course of 30 years, at the end of that period of time, you would have an investment portfolio value of £2,172,334, giving you an annual income of £86,893, which when we convert that back to today's money, that would be the equivalent salary right now of earning £41,000 per year. So unfortunately, it's certainly nowhere near enough to be able to afford you a Lamborghini and a 6-bedroom mansion during retirement, but if you're anywhere in your 20s right now and kind of were able to do this over the course of the next 30 years, you could retire by the time you were probably 50 and still live a pretty good standard of living. Now, if you're not particularly inspired by those kinds of numbers, well, there only are a couple of opportunities, I guess you could say, in order to be able to actually put yourself in a position to accelerate your time to retirement and retire early, or indeed increase the pot in which you have in order to be able to live on kind of more money during retirement. And unless you're kind of, in a high paying job, earning a hell of a lot of money, it's obviously going to be quite difficult in order to be able to achieve that. So it's very important that if you're just working your kind of average job, I guess you could say, that you go on to look to try and increase your income, whether that's through additional side hustles or starting a business, in order to make sure that you can contribute more to that investment portfolio over time and let the compound effect do all of the work for you. Because the compound effect really will accelerate the money and the value in which you will have within your investment portfolio. It's why when you look at the net worth of individuals like Warren Buffett as an example, despite the fact that he was a billionaire by the time he was 50, he still has acquired over 99% of his wealth during the latter years of his life, which is certainly an interesting paradigm to think about, because Warren Buffett only actually created 1% of his wealth by the time he hit 50 years of age, Whereas a lot of people at that point in time are looking to kind of wind down, kind of start to withdraw and liquidate all of their assets in order to live off what they've been able to produce during their working life. So I guess the ideal outcome is that you actually end up with a bigger investment pot than you actually need to live on, and you can still go on to grow your wealth throughout the course of the remaining part of your lifetime too. So with that in mind, should you only invest into the S&P 500 in order to be able to retire and live financially free and get yourself a big income during your later years in life in order to live out a luxury lifestyle during all of your golden years? Well, the truth is, yes, it certainly can do all of that for you, absolutely, but with that being said, for me personally, I'm not just going to have all of my eggs in one basket, so to speak, and only invest just in one single fund. I appreciate that everyone will have their own kind of individual style of investing and indeed different risk appetites, so what I'm about to say may not apply to you. Because for some, investing into a well-diversified low-cost index fund for the next 30 years certainly will be the best course of action, and that's certainly the course of action which the likes of Warren Buffett advises. But for others, exploring other investment opportunities may be the more profitable thing to do. Investing into things like property or perhaps picking individual stocks which you personally believe have a great amount of long-term potential. Dare I even say perhaps investing into cryptocurrency. For me personally, I've shown that I've invested into all of these kind of different asset classes through my investment portfolio updates. But that certainly doesn't go to say that I'm right in my investment approach. It's just my own personal approach to investing. And whilst I may not outperform the S&P 500 over the course of the long term, I still feel like I'm young enough to take a few more additional risks on my investment portfolio to at least see if I can try. So that said, guys, investing into the S&P 500 in order to be able to retire is certainly possible. But if you would like to learn a little bit more about potential other investment opportunities that you could get into, then be sure to click on this video here. And if you did enjoy this video, guys, be sure to drop a like on it, subscribe to the channel if you're new around here. With that being said, I'll see you over in the next video.